Welcome back to the deep dive. Today we're doing something a little different. We are taking one single massive institution, HSBC, and using it as a case study.
A really high-stakes one.
Exactly. We're not just analyzing a bank here. We're trying to pull out these universal lessons about globalization, about risk, and really the future of finance. So if you want to understand the actual blueprint for how money and trade move across borders in, well, 2025, you are in the right place.
That's absolutely right. When you look at the Hong Kong and Shanghai Banking Corporation, you're not just studying a company. You're studying an organization that really embodies global complexity.
Right.
Our mission today is to synthesize the strategic lessons here, specifically their aggressive global strategy, that tightrope walk of risk management, and how they are digitally adapting to survive in a world of fintech.
And to get their strategy today, you have to start at the very beginning. The origin is everything.
It really is.
HSBC was founded in Hong Kong, 1865. And it was founded for one explicit reason: to finance the trade flowing between Europe and Asia.
That's the key.
It means their mandate was cross-border from day one. It's what still defines them as one of the most, internationally focused banks in the entire world.
They're a bank built on movement, not just serving a domestic population. That initial purpose, that DNA, it means their entire structure is optimized for bridging these huge regulatory and currency gaps.
Okay, so let's unpack that structure. HSBC calls itself a global universal bank. It sounds strategically diverse, but my God, it also sounds incredibly complex to manage.
It is.
What does that all-in-one model actually look like on the ground?
Well, the universal bank model means they operate across almost every single facet of finance, all at the same time.
Okay.
So for you, the individual listener, that's retail banking. For your business, it's commercial banking. For managing immense wealth, you've got wealth and asset management.
And then the big stuff.
Then you have investment banking, underwriting deals, issuing bonds, and finally, the engine that powers their entire history, international trade finance.
So on a Tuesday, they might be approving a small business loan in Birmingham, and then on Wednesday, they're helping some Chinese manufacturing giant issue equity in New York.
Exactly.
That scale is just staggering. But isn't that universal model inherently riskier? I mean, we saw major banks forced to spin off divisions after the 2008 crisis because managing that complexity just became impossible.
It is inherently complex, you're right. But the strategic advantage, well, it outweighs the operational risk if you manage it correctly.
A big if.
A very big if. The primary benefit is synergistic revenue. Yes, diversification spreads risk if one sector slows down, but the real power is in the cross-selling.
Ah, okay.
If we have a multinational corporation as a commercial client, we can then offer their executives wealth management services. And then when they need to raise capital, their IPO goes right to our investment banking arm.
The goal is to maximize the lifetime value of that customer relationship.
Precisely. And in doing so, you create these really high switching costs. It's hard to leave.
That makes perfect sense. They kind of lock you in by providing these integrated services across your entire financial life. And that brings us to their bottom line. How sensitive are these profits to, external factors?
Oh, highly sensitive. Their revenue streams, interest on loans, massive fees from international payments, investment banking deals, foreign exchange trading, all of it responds instantly to global macro factors.
So if a central bank moves...
If central banks raise base rates, the interest they earn on loans just shoots up. That can boost profit dramatically. But conversely, a dip in global trade activity or political instability that locks up shipping lanes.
Right.
That instantly reduces those highly profitable international transaction fees. They are, in a very real sense, a seismograph for the global economy.
Speaking of that seismograph, this is where their strategy gets really interesting. While a lot of global banks are still heavily tethered to Europe and North America, HSBC is defined by its geography. They operate everywhere. But what makes their footprint so distinct from, say, a Citigroup?
It is the relentless, explicit, strategic emphasis on Asia. I mean, they still maintain crucial operations in Europe and the Middle East, of course.
But the focus has shifted.
The sources are crystal clear on this. They are pivoting resources to China, Hong Kong, Singapore, and other emerging Asian markets. The organization believes, fundamentally, that future global economic growth will be driven primarily by Asia.
So they're allocating capital where they believe the next generation of GDP will be created.
It's a classic move. Follow the growth, follow the wealth.
But who exactly are the customers that justify this massive global network? Who gives them that competitive edge over a domestic Chinese or Singaporean bank?
They target the cross-border customer, the one a purely domestic bank just cannot serve efficiently. That's their sweet spot.
You mean my example?
Okay, so multinational corporations that need cash management in a dozen different currencies. Or global trade businesses that need letters of credit issued in 3 different time zones.
People on the move.
People and money on the move. High net worth individuals moving assets for tax reasons.
Yeah.
And this is a big one, international students and expatriates who need a seamless banking relationship as they physically relocate. They specialize in complexity and movement.
And we've seen that belief translate into tangible action. They've been very public about restructuring their global presence.
Yes, we're seeing a clear strategy of what's called retrenchment.
Which means?
It means they are actively reducing operations in lower growth Western markets, sometimes selling off entire consumer banking units in places like France or parts of the U.S.
And reallocating those resources.
And reallocating those vast resources right into high growth areas in Asia. This is resource allocation at a monumental scale, designed to maximize long-term shareholder value. It's like pruning the slow-growing parts of a tree to feed the high-growth branches.
That decision to be truly global must mean they have to manage a spectrum of risk that is, well, it's almost unmatched.
Oh, absolutely.
Banking is regulated everywhere. But for HSBC, the risk landscape must be less a list of dangers and more a minefield of potential disasters.
That's a good way to put it. It goes so far beyond the standard financial risks. Obviously, they handle credit risk, the chance of loans going bad, and market risk, which is volatility in the prices of assets they hold.
Standard stuff for a bank.
Standard stuff, yeah. And then there's liquidity risk, which is crucial. The risk they can't meet their short-term cash obligations. But the greatest operational threat, the one that keeps executives up at night, is the sheer cost of compliance and regulatory risk.
That must be the most expensive headache. I mean, they have to know and follow the rules in every single country they operate in.
And those rules are often contradictory. They're in different languages, enforced by local regulators who don't necessarily coordinate with each other.
Wow.
They're required to maintain absolutely massive compliance departments. And the sources emphasize that historic failures here, specifically around money laundering controls, have resulted in these headline-grabbing fines.
We're not talking small penalties.
No, we're talking about fines that can run into the billions. Fines that can effectively wipe out the profits of an entire division for a year. That shows how regulatory risk directly hits the balance sheet in a way few other failures can.
And because banks of this size are deemed systemically important, the scrutiny just never, ever ends.
Never. They're constantly being scrutinized by multiple government regulators, international watchdogs, financial authorities, the media, everyone. The corporate governance structure has to be ironclad.
Because a failure could be catastrophic.
Because poor internal control in an institution of this magnitude can create systemic risk across entire national economies. It's why banks like this operate in what's really an oligopolistic market, dominated by just a few giants.
So the competition is limited to a handful of peers, JP Morgan Chase, Citigroup, maybe Deutsche Bank, Standard Chartered. But is that competition still fierce?
Absolutely, but it's not based purely on price. Competition among these giants is based on trust, the depth of their global network, and increasingly their digital capability.
How so?
Well, if you are a multinational corporation, you need a bank that can facilitate payments instantly and securely between, say, Shanghai and Frankfurt. If your competitor's bank can do that faster or with greater reliability, they win your business. Simple as that.
That brings us perfectly to digital transformation. Traditional banks have been playing catch-up with fintech for a decade now. What heavy lifting has HSBC prioritized?
They've been pouring capital into building resilient infrastructure. That means moving core systems to the cloud. Huge investments in state-of-the-art cybersecurity.
Which has to be a top priority.
A top priority, especially for those cross-border systems. And then building seamless mobile banking platforms. But the real strategic investments are in the operational technologies.
Like what specifically? How is their founding purpose, that trade finance mission, being updated with tech?
Okay, the perfect example is their application of blockchain for trade finance. International trade has historically relied on these complex, paper-heavy letters of credit. Transactions could take weeks.
Right, a very slow, manual process.
Very slow. But by using distributed ledger technology, They can increase transparency, reduce the chance of fraud, and radically speed up the settlement time. It's taking the reason they were founded in 1865 and making it instantaneously digital.
And what about on the data analysis side of things?
They use artificial intelligence extensively, not just for basic fraud detection, but for enhancing credit assessment, especially in emerging markets where historical data might be scarce.
Right.
Data analytics drives automation, which is critical. When you're processing transactions across dozens of time zones, you need high-speed data processing and a totally reliable IT infrastructure. The organization is fundamentally shifting. It's becoming a technology-driven service organization, not just a traditional brick-and-mortar lender.
Moving beyond profit and tech, banks are now facing this immense pressure from society. Environmental, social governance, CSR.
Is this just marketing, or is it a true strategic shift? It is rapidly, and I mean rapidly, becoming a strategic mandate. The pressure is coming from all sides. Ethical lending practices, supporting financial inclusion, and crucially, managing climate finance.
So things like green bonds.
Green bonds, yes, but the most challenging area is the pressure to reduce or even eliminate financing for high-carbon activities, fossil fuel projects.
That creates a massive tension, doesn't it? As a global universal bank, I mean, they serve huge energy companies. They have deep relationships in regions like the Middle East that rely on these industries.
Exactly. That's the tightrope. They have to de-risk their portfolio from fossil fuels while somehow maintaining these profitable long-term relationships with major energy clients in critical regions.
So what's the tangible commitment?
The strategic importance is underlined by their specific public commitment. HSBC has committed to financing the transition to a low-carbon economy. It means they are actively redirecting capital towards sustainable investments and clean technology. This is no longer a PR exercise. It dictates where billions of dollars in future lending will go. It's forcing them to reshape their entire client base over the next few decades.
This has been a true deep dive into just immense complexity. Let's try to synthesize this.
What we see in HSBC is an institution operating right at the intersection of globalization. These huge regulatory requirements, continuous technological pressure, and now rising demands for sustainability. They are a textbook example of a complex, adaptive organization.
So if the listener had to walk away with one central strategic lesson from this whole case study, what would it be?
The core lesson, I think, is that long-term success in global finance hinges on three pillars. First, you must manage your operational risk, especially compliance and cyber risk, as effectively as you generate revenue.
They have to be equally important.
Equally. Second, you have to continuously adapt to digital change just to maintain operational speed. And third, you absolutely must align your strategy with the shifting centers of global economic growth. That decision to prioritize Asia is a fundamental bet on the direction of global GDP.
And that focus is all about who they want as a customer, that cross-border player who needs everything integrated.
Precisely. Their strategy is built on cultivating these long-term, sticky relationships. They want customers who need integrated financial products globally, which in turn encourages that loyalty through trust and, let's be honest, through very high switching costs.
Okay, that leaves us with a final, provocative thought for you to consider as you wrap up this deep dive. Given this aggressive strategic pivot to Asia and the heightened geopolitical tensions between major global powers, how quickly could a truly global bank like HSBC be forced to fundamentally restructure its identity and governance?
You mean moving capital, staff, core infrastructure?
All of it, if those tensions escalate. What does that tell us about the future stability of any institution that operates across major ideological fault lines?
That decision. It might just be the biggest financial chess move of the next decade.
It certainly could be. Thank you for joining us for the deep dive.